What is a bull market and why should you care about it? The terms bull and bear are frequently used in the investing world to describe market conditions. These terms describe how stock markets generally perform, that is, whether they are appreciating or depreciating in value. As an investor, market direction is a major force that has a significant impact on your portfolio. As a result, it's critical to understand how each market condition may affect your investments. So let's dive into the video to know all about a bull market and whether you should invest at that time. Here we begin. A bull market is a financial market condition in which the prices are rising or are expected to rise. The term bull market is most commonly associated with the stock market, but it can be applied to any traded asset, including bonds, real estate, currencies, and commodities. Because security prices rise and fall almost continuously during trading, the term bull market is usually reserved for extended periods where a large portion of security prices rise. Bull markets can last for months, if not years. Bear market versus bull market. A bull market is one in which the markets are rising and the economic conditions are generally favorable. Conversely, a bear market exists when the economy contracts and most stocks lose value. Because investor attitudes greatly influence financial markets, these terms also denote how investors feel about the market and the resulting economic trends. A bull market is distinguished by a steady rise in prices. For example, a bull market in equity markets denotes an increase in the prices of company shares. In such cases, investors frequently believe that the uptrend will continue in the long run. The country's economy is typically strong in this scenario and employment levels are high. A bear market, on the other hand, is in decline. Unless a market has fallen 20% or more from recent highs, it is not considered a true bear market. Share prices are constantly falling in a bear market. As a result, investors believe the downward trend will continue, perpetuating the downward spiral. During a bear market, the economy slows and unemployment rises as businesses begin to lay off employees. Characteristics of a bull market. Bull markets typically occur when the economy is strengthening or is already strong. They usually occur with a strong GDP and a drop in unemployment and frequently coincide with increased corporate profits. During a bull market, investor confidence will typically rise. As a result, the overall demand for stocks will be positive, as will the overall market tone. Furthermore, during bull markets, there will be a general increase in the amount of IPO activity. Notably, some of these factors are more easily quantifiable than others. While corporate profits and unemployment can be quantifiable, determining the general tone of market commodity, for example, can be more difficult. The supply and demand for securities will oscillate. Supply will be low while demand will be high. Investors will be eager to purchase securities, but few will be eager to sell. During a bull market, investors are more likely to participate in the stock market to profit. What causes a bull market? A bull market is a natural byproduct of the stock market, which experiences boom and bust cycles. The onset of a bull market begins a period of expansion and eventually leads to an economic peak. According to experts, businesses run out of room for growth after a prosperous period and enter a down cycle. Not all downturns result in full-fledged recessions, some are only temporary. You're likely to see multiple bull markets in your lifetime, and they will only sometimes have a clear catalyst. Changing bull market tides will always be predictable. However, some bull and bear markets are beyond anyone's control. The COVID-19 pandemic and the war in Ukraine have contributed to the uncertainty in the last 2 years. The natural forces of the market will only able to be correct some things, especially given the current level of inflation. For example, inflation typically reduces consumer spending and amplifies stock market declines. How to take advantage of a bull market. Investors who want to profit from a bull market should buy early to capitalize on rising prices and sell when they reach their peak. Although it is difficult to predict when the bottom and peak will occur, most losses will be minor and temporary. Several prominent strategies used by investors during bull market periods are discussed ahead. However, because it is difficult to assess the current state of the market, these strategies also involve some kind of risk. Purchase and hold. Purchasing a specific security and holding it to sell later is one of the most fundamental strategies in investing. Moreover, this strategy necessitates investor confidence. Why hold on to security unless you expect its price to rise? As a result, the optimism that comes with bull markets helps to fuel the buy and hold strategy. Trading in full swing. Full swing trading is one of the most aggressive methods of attempting to profit from a bull market. Short selling and other techniques will be used by investors using this strategy to try and squeeze out maximum gains as shifts occur within the context of a larger bull market. Increased buy and hold. Increased buy and hold is a riskier variation of the straightforward buy and hold strategy. The premise of the increased buy and hold strategy is that investors will continue to add to their holdings in a particular security as long as its price rises. Retracement add-ons. A retracement is a brief period during which the general trend in security price is reversed. Even in a bull market, stock prices are unlikely to rise indefinitely. Rather, there will be shorter periods when small dips occur, even as the overall trend continues upward. Some investors look for retracements within a bull market and buy at these times. The thinking behind this strategy is that assuming a bull market continues, the security price will quickly rise, providing the investor with a discount purchase price retroactively. How to invest regardless of the market. A bull market is not an invitation to invest aggressively. A bull market also does not indicate that you should put your investments on hold. Smart investing is similar to using cruise control. Regardless of your experience or risk tolerance, consistent investing is essential for navigating the inevitable bumps in the road. Before investing, experts recommend you have an adequate emergency fund set aside. In the event of a medical emergency or unexpected layoff, this fund should be able to cover 3 to 6 months of expenses. You want to avoid taking money from your investments to make ends meet. Another rule of thumb, according to experts, is to avoid investing money that will be needed shortly. The volatility will be very real in the first 5 years. After 5 years, the likelihood of your investment increasing in value is greater than 96%, which is a fantastic statistic. Investing will be emotional, whether exciting, discouraging, or terrifying. Indeed, investor confidence, or lack thereof, significantly impacts the duration of bull and bear markets. There isn't a single investor who hasn't experienced the agony of a bear market or the exhilaration of a bull market. On the other hand, those who focus on their long-term horizon are the ones who see the best results. What do you think of the bull market? Have you ever invested that time? Let us know in the comments down below. Thanks for watching. Take care.